Good morning, everyone. We're just going to wait a minute while everyone is joining the webinar. Thank you. All right, we will get started. Thank you so much for joining us this morning, everyone. My name is Laura Sager. I am the Education and Membership Director here at Conejo Park Association of Realtors. Welcome. Today we have what triggers a property tax reassessment. We have two presenters today. We have first Roxanne Danielson, the Senior Title Officer of Chicago Title, will be presenting first, and after that, Keith Taylor, the Ventura County tax assessor. Welcome. Thank you so much, both of you, for joining us. We're going to start with Roxanne, and then if there are any questions that come up, feel free to put them in the Q&A. And Roxanne will answer those questions after her presentation, and then Keith will take it from there with his presentation. And let me share your screen, Roxanne, and we'll get started.
Thank you. All right. I'm going to give you an explanation of what happens on our side, the title side, when a property is triggered for reassessment and how it will affect the title. Next slide. Thank you, Laura. And this is something that I learned back in escrow back in 1979. So the first thing we're going to do is understand the tax roll and then the important dates for property taxes. And I was taught no darn fooling around. And that's just something that stuck. And so it's the date that the taxes become due, the date they become delinquent, and that's for the first and second installments. And then we're also going to be dealing with supplemental taxes, delinquent taxes, what triggers a reassessment, who's responsible for the tax bills, and then the preliminary change of ownership report, PCOR, sometimes people call it a PCOR, and how it affects your taxes. One item that I don't have in the agenda that I added in is Proposition 19, which handles the transfer between parents and child, grandparents, child, property damaged by fire, etc. So that's also going to be covered. Next slide. And I have been with Chicago Title now for 3 years. I've been in the title industry for 40 plus years. Did escrow for about 3 years prior to getting into title. And I am passionate about finding solutions to the problem. So if it's something that we need to dig a little further, I'm so grateful to have Keith as one of my partners in crime that I can go to him and say, can you help me with this, or can you find someone to help me? And his team has been really great and very helpful with getting things resolved. Next slide. So understanding the tax roll. So we have a program called Title Point that we use. Other companies might have other programs, but we can put in either the property address, the assessor's parcel number, or sometimes we can run an owner's name and see if we can find the property that we're looking for. Within that tax roll program, we can click on the link that attaches the legal description, so we can pull up the chain of title. And sometimes we'll see that the owner on the tax roll is not our current owner, and that's because the county's behind in posting the changes of ownership. And so we will just keep going forward. And if there's a discrepancy, I always let our title point know that we're missing a deed, or they've misposted it or didn't post it at all. And there was nothing wrong with the document. It just simply got missed. Also, the assessor's office, if the wrong reference is posted on the tax roll, that won't be fixed until the following tax year. So that's something that if your client receives or you receive a property profile and the taxes have a former owner's name, just know that it's just something that has not been updated yet. Okay, and on the tax roll, it will provide the assessor's parcel number, which references the book, the page, and the parcel of the property that we're dealing with. We also can access the assessor's parcel map to confirm that everything is correct, that we're dealing with the right property. If there is anything that's, going to alert us, hey, when we open a title order, we receive notification if there's delinquent taxes, if there's supplemental taxes, or delinquent supplemental taxes, or if the taxes haven't been paid for a long time, now they're going delinquent, and we call them going to sale. So what that means is now we have to pay them with a redemption. Can you go to the next slide, Laura? So the fiscal year for taxes is July 1st through June 30th, and the taxes get billed in 2 different installments. So the first installment is due November 1st. So that's the no for the no darn fooling around. Delinquent by December 10th. Then the second installment is February 1st, delinquent by April 10th. The taxes, if they don't get paid even with the penalty prior to July 1st, that's when they start the redemption. So then it's no longer paying the installment plus the penalty or the late charge. Now it's going to roll monthly into a redemption figure. And sometimes, if people continue to go delinquent, within 5 years, it could go up for tax sale. And most times we as title don't insure a property that someone has purchased at a tax sale. And that's because of the inability to make sure the proper notice was given. It's not like a foreclosure that we normally deal with. So when the second installment comes due, there is an added penalty, and it's just like an extra cost. So it's not a huge thing. So taxes not paid by the delinquent date are charged the penalty, the fee, and then as of July 1st, it's going to go into a monthly installment. Can you go to the next slide, Laura? And the next slide. So this is just a sample of an actual county supplemental tax bill that's from the county website. And it's going to let us know that they had new construction completed. So anytime there's new construction, it will trigger a reassessment, because we don't know whether they've added on to the building, they put on an ADU, they've built a swimming pool. So those kind of improvements will trigger a reassessment. And so in this particular case, it shows that the construction was completed July 1st of 2020, and they billed this on 11/15 of 21. And what happened is it just never got paid. So people, a lot of times the county will send out a notification. In fact, you'll get a little tiny postcard and will tell you what they're going to base your assessment on for the following tax year. But a lot of people don't pay attention to that. So, and then they get the tax bill, and maybe they had a different address. Maybe they had the wrong address on their grant deed. So these are things, but they get overlooked. But the party that is billed is responsible, and they need to go to the county website. So if you're dealing with a new buyer, make sure to let them know a tax bill will be coming. It might be in the former owner's name. If nothing else, it is your responsibility to check the website And if you have an impound account, make sure that your lender gets a copy of that tax bill. So this actually came from a situation where we closed a sale transaction. The same day that it closed, the supplemental tax bill was sent. And the owner didn't know anything about it. My escrow didn't know anything about it. And so unfortunately, it stuck to the property. And it was issued prior to the owner physically being off the public record. And so this was something that they had to deal with in escrow. But normally a supplemental tax, if you see it on your preliminary title report, we're going to show the status, whether it's unpaid, open, delinquent, and then what the amounts are to pay them. And normally at the close of escrow, we will get all the taxes paid, or if it's something that the lender showed that they have an impound account, we as title still are responsible for making sure that the taxes are paid. So sometimes we'll hold that installment plus penalty until we get verification that it's cleared through the county website. Next slide. So what triggers reassessments? It's the recording of an affidavit death of spouse, affidavit death of joint tenant, affidavit death of trustee. And the PCOR is something that tells the assessor's office what the transfer is all about. If it's between family members, it's important that they know that. And I'm going to refer to now, it's going to be my page 17, which is the Proposition 19. So, and also if someone is doing a quitclaim deed, sometimes we'll see uninsured documents and we don't know what that conveyance was all about. So it will not only trigger a reassessment, but now you're going to have uninsured documents. We're going to have our requirements for title. But so anytime you have a quitclaim deed, grant deed from someone, taking someone out of title, usually it's not adding in, or sometimes it could go from individuals into their trust. So those are the items that they'll be exempt to the reassessment. And that depends on if the successor trustee, were they a family member? Because if they were strictly acting as trustee, no relation to the party, that could cause a reassessment. So transfer tax is shown on all sale transactions. Back in the day, they used to say they're not showing it, but now we show it. And it's $1.10 per thousand based on the sales price. So that is the amount that the assessor wants to make sure, A, the transfer tax was collected properly, B, the PCOR shows the sale price correctly, and then they are going to go through and do a reassessment. If the property has changed from one party to another party, and then that party never got their supplemental taxes, and they've now sold the property before that tax bill gets issued, it's going to roll to the unsecured tax roll because it was something against that particular person and transfer has already taken place. So it's not against the property. So we are responsible as title to verify the transfer tax, verify if there's no transfer tax that we have a proper exemption, and we have to show, what this conveyance is all about. The PCOR backs up that documentation and provides the details of what the transaction or the conveyance was all about. So we also deal with the state of California SB2, and that doesn't have anything to do with tax reassessment. It's strictly a fee for the state of California. And that is if somebody is selling, then the document is not subject to the $75 fee. If it's concurrent, the grant deed, we add the sticker that says it's concurrent. So we also avoid it there. And then if it's no documents recording other than a deed of trust or those type of conveyances or encumbrances, those are subject to the $75 without any reasoning. So transferring into your trust or out of your trust to yourself as individual does not trigger the reassessment. Addition of a spouse or removal of a spouse. So husband and wife, we want to make sure, and we have to show that either it's subject because of a divorce or just one party to the other. Maybe the lender is requiring something. And then a corrective name. So when we record a deed and it has a wrong spelling, wrong name, maybe they were supposed to have a hyphenated name, what have you, then we'll do a correction deed. So those tell the assessor that the original deed had an incorrect spelling, and so that's why it's being recorded. And then if someone is going in or out of their own entity, an LLC, corporation, etc., we want to make sure that it has the proper exemption on there as well, that we know that they are all the same parties. And on some occasions, we have to provide a copy of a partnership agreement, operating agreement, articles of incorporation, so that the assessor knows that we are dealing with the same parties and not subject to reassessment. So any documents that do not transfer title, such as a deed or trust, any kind of releases, those do not trigger reassessment. Next page. So this is something where we have to show why the transfer happened the way it did. So when we show that it's either subject to a deed or trust of record, or one spouse to another, or maybe somebody is only going to give away 50% of their interest, whether it's to a family member, someone else, we don't know. So we have to show that they were adding someone in, and this is subject to a 50% interest. And so transfer tax is not required by the recorder. So just to keep in mind, a lot of you may not deal with refinances, but in Ventura County, if you have a deed concurrent with a deed of trust, and that deed is adding someone into title or taking someone out that is not their spouse, it is subject to transfer tax based on whatever interest they have on the loan amount. And so let's just say it's 50%, the loan amount's 500,000. They're going to tax on 250,000 at $1.10 per thousand. And it's not a sale. And this is something that maybe Keith can answer during his time, is when that transfer tax is showing on that situation where it's not a sale, I'm not sure how that is handled as far as reassessment. But so the only document, the only deed between husband and wife is non-taxable with transfer tax. Next slide. So in this case, they removed someone from title and they changed it from single man, single woman, where they had 50-50 because of joint tenancy. Now they have an undivided 25% interest, another undivided 25% interest, and 50%. So we put on here that it was a bona fide gift, but in Ventura County, that is not going to fly. So if the deed had recorded all by itself, which I think this one did, this would be fine. So this would not be subject to transfer tax. But if it's recorded concurrently with the deed of trust, again, it's going to be based on whatever interest is changed, whether someone's being added in or taken off. Next slide. So the deed with transfer tax does trigger the reassessment based on the new sales price. And so on this document, the county is showing that the total fees includes the transfer tax plus a recording fee. And so if we record a deed and maybe the sales price changed and escrow forgot to notify us and it gets recorded, sometimes we'll have to ask for a refund, but there's a $75 charge to try to get that. So we want to make sure prior to us recording anything that everything is accurate. So we will look at the preliminary change of ownership report. We're going to look at the lender's instructions. We're going to look at escrow's instructions. and then calculate the transfer tax to make sure it's correct. Next page. So in this case, the documented transfer tax shows that it was based on the full interest. If you have someone that is purchasing less the existing deed of trust that the current owner has, sometimes we see that. So the transfer tax is going to be the sales price less the balance of the existing loan. And then the tax is based on the cash that's actually paid. So that's how that would change. Next slide. So who's responsible to pay the property taxes? So if the supplemental tax bill is issued at the time and it's showing on our prelim, that current owner is going to be responsible and it's going to be paid. If it comes after they've come out of title, then it becomes the unsecured tax lien against that owner's name. And it's kind of a gray area when we're dealing with the time that the tax bill goes out versus the time that the ownership changes. So that's something that we would have to rely on the tax collector, tax assessor for their input on that. Current owner, any taxes that are due delinquent that are secured and supplemental, escrow is going to pay that, or we will pay it through our sub-escrow, which is our payoff department. When your owner has a change of address, you're closing, you're representing your seller, make sure that you have a current forwarding for them. Make sure that you have an email, phone number, etc., because we can actually save them. If we find out that a tax bill has been issued as supplemental, we can send it to them and say, just so you know, this was issued, and let them pay it before it becomes delinquent. So the current owner needs to make sure if there's any kind of construction going on. We don't physically go out and see most of the properties that we're insuring. It's a certain liability for us. So if you're going to list a property and you see, construction underway, make sure that you let escrow know so they can let title know, because we know that that's going to not only cause issues with the taxes, but also mechanically issues for us. So then a new buyer, they're going to receive prorated taxes. And that is based on July 1st through whatever date they're closing. And then it's going to be January 1st to June 30th. And it depends on when the property is closing, because for us, our recording date is our closing date. And the escrow handles all the prorations. Title does not do that at all. So they need to be aware that they're dealing with taxes that are on the current assessed owner. They're subject to a supplemental tax bill, which is like a bridge. So it's going to go from the current tax base to the new sales price. And sometimes they could get 2 or 3 tax bills depending on the proration time. And so it could take as little as 6 months, but it could take up to 2 years for them to get that tax bill. So if they don't get anything, they can't do, say I didn't receive it, because the tax website is, easily available, and they can put it in by their property address. If they have their assessor's number, they can put that in, and then they can even pay online with a credit card. Next slide. So the PCOR, Ventura County made a change in May of 2023. If we are presenting documents for recording and they have the expired one, that's not going to be acceptable, for recording. And if we pull the PCOR, there's going to be a fee to that owner, as well as not providing the proper information to the assessor that they need. So we always will make sure, if it's an old outdated one, we'll let your escrow know and try to get a current one so that the correct information is shared with the assessor's office. Next page. So the change of ownership is what gets reassessed or causes the reassessment. And it's how that was completed, whether it's, again, a deed, a quit claim, a affidavit of death. anything that could trigger the reassessment, and we won't know until that document gets recorded, gets reviewed by the assessor's office, and then goes to the county tax collector. So if you receive a notice that your property is going to get reassessed, you can always check with the county assessor, find out why. And they will have more answers for you as to what they based it on. Next page. So the assessor's office, their website is really easy to access. You can also check the tax collector's website if you know that you want to pay your taxes. And so they do have certain properties that are excluded from reassessment. So they have a link on their website for that. Next slide. So Proposition 19 is where if it's your primary residence and you're 55 or older and you want to transfer your tax base, you can do it with that form. You can also benefit from it if you were a victim of wildfires or other natural disasters, and certain inter-family transfers like parent to child, grandparent to grandchild. It used to be under a different proposition, but this information is also available on the county's website, and I would highly recommend it. It will save your clients a lot of money if they are selling and purchasing a home. And now it's throughout California. It used to only be with certain counties. So that's great news. Next slide. So they actually have on our website, we have a Prop 19 estimator. So if you go on to our website of Chicago Title Southern California, go to our information and it'll show you, and we actually have some flyers that have additional information that are shown here. But if you go to our website, you'll see the link and it'll open it up to a detailed document for you. Next slide. And if you have any questions on a specific property, your own property, client, what have you, you can always send me an email. I'm happy to pick up the phone, whatever works for you and your clients, I'm happy to assist. Thank you so much.
Thank you so much. Really appreciate that, Roxanne.
Sure.
We will be sharing the slides for both presentations with all of the attendees. I believe we have a question. Let's take a look here. Okay, so Fred is asking, how can we challenge a county appraiser's valuation of a property?
I think that's going to be for Keith.
I can answer that. There's two ways to review the property value on that. One, we have what's called an informal review by contacting our office. You can ask us to look at that value to determine whether it's correct. Obviously, we might want to ask for additional documentation from you to make that review. If we can't come to an agreement that there's some change that needs to be done, the formal process is filing an appeal with the clerk of the board. Usually the timing for the regular assessment year is from July 2nd through September 15th. And the clerk of the board then kind of handles the processing of your claim form and then schedules a time in front of a three-member panel assessment appeal board to make a determination on which side has the correct value. Although that process, the formal process is going another route, we still maintain communication with the property owner to try to see if we can resolve it before it goes to appeal.
Thank you. So we have a couple more questions. What kinds of construction work force a property to be reassessed? Interior upgrades or just when you're adding square footage? And then there's a clarification after that, just to clarify, in what scenarios do you pay transfer tax?
So under that construction, we don't know about interior remodeling, and I doubt that the county would know that either. So it would be adding additional square foot either by building up, building out, and also I believe adding swimming pool, anything that's going to add value to the home. So they're going to reassess based on that. And transfer tax won't be required on the construction loan unless they're, adding someone into title or taking someone out of title. And it would be just based on that loan amount.
All
Yeah,
right.
that's correct too, as far as interior items go. Sometimes when a kitchen is remodeled and they're keeping the same layout, that's not reassessable. But if they're adding square footage or changing the layout, maybe adding a center island to that, that could cause some reassessment for those types of interior remodels.
A couple more questions. Does adding solar trigger a reassessment?
So originally, when you get the original solar panels, they are exempt. They just passed a law that goes now through, I think, 2029. But when the home sells, the panels are now included in the value of that property. So initially, when you install the solar panels, they are exempt from new construction.
Why do segregated taxes take so long in new builds? Sorry if I'm mispronouncing that.
Oh, so if the taxes are under the developer, and it's covering the whole unimproved land, then the county assessor has to go through and see when all of the deeds record. So coming out of the subdivider into the individual owners is a process, because they're going to have numerous phases. They're going to not be all built at the same time. And I know Keith and his team were amazing and helpful to us, because there was a new tract in Camarillo that was a 55 and older. And we needed to find out, do you have what the assessor's parcel numbers are going to be? And then we could map out that tract and find out, hey, if we have something over on this street, this is what this APN is going to be. So we could actually look at the assessor's map, because it does take a long time. It's just new builds, right, Keith?
Absolutely. Subdivisions are quite complicated because of that. It's going from one big parcel or several big parcels into individual parcels for the homeowners. And so it takes us some time to understand that and map those parcel numbers, and then wait for the recordings to come through where we can apply value to the lots that are selling.
All right, and I think we have one last question before we'll continue with Keith's presentation. If you're removing walls, could that cause a reassessment?
I would say in most cases not. And if a removal of wall is going to cause some other action, there might be some reassessment if it's adding value again, as Roxanne said. But in most cases, if you're just taking out a wall to expand your living room, no, that would not be reassessed.
I have a question for you, Keith. So if someone goes to pull a permit with the county, does that notification go to your office so that you know that somebody's building a block wall or a swimming pool or something like that?
That is correct. Yeah, we have relationships with all the cities and also the county in the unincorporated area to get those permits. And then we determine if those permits cause new construction. So if you take out a permit for a new roof, that's usually not going to be reassessed, but we still get that permit and have to review it and then determine that there's no reappraisal event occurring.
Awesome.
Hey, thank you both. Keith, would you like to share your screen, or would you like me to share your slides on this end?
Or if you don't mind, maybe you can share my slides. Thank you.
All right, I'll go ahead and do that.
All right. Good morning, everyone. It's my pleasure to be speaking in front of the Conejo Moore Park Association of Realtors. We did this presentation maybe about a year ago. Laura asked me to speak a little bit about what triggers this reassessment in California. Roxanne did a fantastic job of describing some of the things that happen with the reappraisal that's actually beyond my scope, because she touched a little bit on the tax collector. So I'm really going to talk about my perspective from the assessor's office and how we incorporate our work into reassessments and how that affects you in the long run when you receive your property tax bills. Next slide, please. So the main driver of our reassessments is triggered by Proposition 13, which was passed in 1978. This is really dictates what the assessor can reassess and when they can reassess. The basic provisions of that law, well, first of all, Howard Jarvis, the picture there, he was the co-author of it. And basically Prop 13 was trying to limit the growth of property values in California. And so at that time, property assessments were being done, revalued every 2 to 3 years. And then there was about a 2.3% tax rate that was applied to it. So Mr. Jarvis decided that he wanted to author something where he could limit that property tax growth so people could afford to stay and live in their houses. Next slide, please. So some of the basics of Prop 13 was to establish a base year value for all property as of 1975, though this law passed in 78. It said the only time the assessor can reassess property was in a change of ownership or new construction. It also limited the tax rate to 1%. And it said the value of those properties are limited to a maximum of 2% a year under this law. So we're not assessing it at market value every year. I do get quotes and things from people telling me, oh, you reassess my property every year. Well, I don't reassess it. It just automatically goes up that CPI that is given to us by the Board of Equalization. Next slide, please. So one of the main drivers, obviously, in reassessment is change in ownerships. We saw a huge number of changes during the pandemic that really overwhelmed our office because we weren't ready to see so many changes in home assessments. Right now, we're seeing less and less. But basically, as Roxanne said, we get a document from the recorder's office telling us what's going on. So it's usually a grant deed that's filed and recorded with them that's then sent to the assessor's office for review. We review that document to determine if there's a change in ownership, first of all, and then we have to determine if there's a reassessable event that's occurred with this change in ownership. And along with that line, if there was a percentage that was transferred, if it wasn't 100% transfer, maybe it was a 50% transfer that we have to look at and reassess at 50%. And then at that date of transfer, we have to determine what the market value is of that property. Currently, we just moved to a new system that's actually going to help us review these documents in a quicker manner, which will then help facilitate the name changes to the property ownership for people to view. It doesn't necessarily mean the assessments will happen faster, but we do want to make sure that we understand what has changed and update the ownership information in our system, because a lot of organizations and county departments rely on us for that updated ownership information. Part of what we do with the change of ownership, we review that PCOR to make sure that it's filled out properly. We understand what type of transactions occurring. We also look to see if there's some kind of listing out there for this property. It was listed for a while, the number of days it's been listed, and then what the transfer tax is. And those are 3 ways that we actually help verify what that sale price is that then we can add to our assessment roll. And that would create a supplemental bill. And I'll talk a little bit about supplemental bills in a minute. But that helps us determine also the range of value for those properties. And so everything that is done with the recorder side, the transfer tax, the PCOR, very important to us, and we get that information from the recorders. Next slide, please. So Roxanne touched on that, but there's different types of transfers that trigger reassessments and some that don't. Obviously, a purchase of the property, whether it's maybe a transfer to a child and it was the parents gave them somewhat of a deal. We have to look at what actually is the fair market value of that purchase price and assess that as of the date of transfer. interspousal transfer, not reassessable, but it is a name change. It's a change in ownership. We have to update our records for that. Property going into or out of trust, most of the time is not reassessable. I mean, there's very few occasions that might cost something if somebody's added or changed in the trust name. Legal entities, another thing that we look at, this is kind of unique that most of the legal entities are, the legal entity needs to report to the Board of Equalization to tell them what percentage of the corporation or entity is changing. The Board of Equalization makes the determination whether there's a change in control of that property. And if there's a change in control of that property, they report that to the assessor's office so we can reassess the property. One other item wasn't mentioned, but refinancing, and we might see that happen if interest rates go down now, but a deed is recorded when it's refinanced, and sometimes it goes in and out of that trust, but that's not a reassessable event unless there's something that's adding someone onto the title that's helping them refinance the property. So we get those documents, those recordings, and we have to review that to make sure that it's just a straight up refinancing of property with a lower interest rate. Next slide, please. So the other area that causes a reappraisal event is new construction. And as I just said, we receive permits from all the cities and county jurisdictions here. We also get the plans for the properties so we can see what's actually being added. It's very important, obviously, with the new house being built, that we understand what the layout is and the square footage and the type of construction that's going to be there. We also have to determine again whether that new construction is accessible. As I mentioned before, new roofs, sometimes you take out a permit for a water heater. Those items are not reassessable. We are looking for something that actually adds value to the property. So an addition of a bathroom, an addition of a room, an expansion of the garage. ADU is another one that we reassess as new construction. And that new construction is then added on to the old base of the property. So technically you have two bases that we set. The base where the original purchase of the property, and then another base year value that is added on to the old one. And we track both of those. Next slide, please. So new homes, additions, as I mentioned, pools, spas, ADUs, these are all reassessable events. And so we have to really determine what that value is. And we look at it a couple different ways. Most cases, what we do is use a cost approach because that's really determining what that additional cost of that pool is or that ADU is. But we also have to kind of look at the before and after value. So what was the value of the property before and what was the value of the property after that addition? And sometimes that difference is what we would use as the assessed value. Obviously, we compare that to the cost approach. So we're using two different approaches to verify what our range of value for that new construction is so we can add that to the assessment roll. Next slide. So with both of these events, you will receive a supplemental notice. And basically the notice informs the owner of the newest assessment versus the old assessment. So you'll see that on the notice itself. It has a column that shows what the current assessment is and what the new value will be once we add it. This also gives the opportunity to the property owner to contact us if they don't feel that value is correct or that maybe we viewed it a little differently than through the permit that we received. So it gives you 60 days really to contact us to talk about that informal review. But that 60-day period also is a period that if you don't agree with us and we can't come to an understanding, you can file an appeal date. So this is one area where the appeal date is 60 days after the notice date that we send you. And it's not necessarily the July 2nd through the September 15th date. Let's see, a little bit about supplemental notices. As Roxanne had mentioned, tax bills are done through the fiscal year, July 1st through June 30th, but the assessor work is actually done through the calendar year, January to December. So if somebody purchases a property or has new construction that's completed between January and the end of June, that's basically affecting 2 tax years. And there's 2 supplemental bills that will be issued, one for the tax year we're in, and one for the upcoming tax year that would start July 1st. So that bill is considered, or we consider that being in the window period where you receive 2 supplemental tax bills. If the purchase or the new construction is done July 1st through December, it's only affecting that current tax year. And so only 1 supplemental would be issued for the difference between the old value and what our reassessed value will be. And certainly, anytime you receive these notices and you have any questions, you can please contact our office. We'd be more than happy to find someone to explain to you exactly how the supplemental was derived and what your options are for a review or appealing that value. Next slide, please. So another area that has changed since Prop 13 came in was Prop 19. This modified the law for reassessment of the real property transfer to your children, or it also determined or had implications when transferring the base year value to a replacement property. This is probably a bigger issue for realtors, is that base year value transfer. The transfer to the children is called basically an intergenerational transfer now, and we call the second part of Prop 9 the base year value transfer. So I wanted to go through them both just to give you a perspective on them and a little bit how they changed from the old law to the new law. Next slide, please. The intergenerational transfer became effective February 16, 2021. It allowed parents to transfer their child their property, or grandparents to transfer to their grandchild their property, as long as the parents were no longer living. And it had to be the principal residence or a family farm of the transferor. The new law says that the transferee must live in the property now to get the exclusion. And if they don't, and the property just transfers to a child and they don't live in it, then that's a reappraisable event as of the date the property is transferred. In most cases in these intergenerational transfers, it's the date of death of the parents or the last parent that was alive going to the children. If the transfer of the property is in a trust, and it might go, the beneficial interest of the trust go to 3 children, and one of them wants to live in it, that's still, the exclusion is still allowed as long as that child lives in the property and they don't move out at a later date. If they move out at a later date, we go back to that date of death or that date of transfer, and we've already reassessed the property and hold that in our database, and we have to assess the property back to that date going forward under that 2% CPI I talked about earlier. So we have a lot more work to do under this Prop 19 as far as making sure we have the correct value as the data transfer, even though it might not be used until a later date or maybe never at all, as long as the child continues to live in the property. And I'll make a note on that. If one of the children leave and another child wants to live in the property, they can do so too without a reappraisable event, again, as long as they live in the property. The key to this provision is within 1 year of that transfer, the child needs to file a homeowner's exemption or a disabled veteran exemption with our office. The law was very specific about this. And so if it's a year and a day past that, they won't get the exclusion back to the data transfer. It would be only prospectively going forward. And it's kind of a weird thing because there's also a claim form that goes with this intergenerational transfer. And you have up to 3 years to file that form to qualify for the exclusion. So I don't know why they didn't make them the same length of time, but it's very important to remember that file that homeowner's exemption timely in order to get that exclusion. And just a note on that last comment there, that prospective would be okay as long as the transfer isn't before it's sold to a third party. So you have to file this form before the actual transfer it to a third party. So if you held the property, lived in it for a year, and then sold that property and never filed the claim form, you would not receive that exclusion. Yeah, so I really want to emphasize that homeowner's exemption. Slide, please. And this is just kind of a quick idea of how the assessed value might change under this intergenerational transfer. Currently, if the value of the property, that the assessed value that's currently on the property is 250,000, you take that and you add 1,022,600, and I'll explain that number in a minute, how they got that. And so based on that number, 1,272,600, as long as the value as of the transfer date, so we look at that transfer date, is 1,272,600 or less, there's no added taxable value. If the market value is higher, say 1,000,003, then 27,400 is the difference between those two amounts, and that's what would be added on to the 250. So you get a partial exclusion plus a partial reassessment of that property. When the law passed, there was $1 million figure, and that changes every 2 years in February. So February of 2023, the Board of Equalization had determined a CPI to apply to that $1 million. And as you can see, that's the number they came up with. And then in February of 2025, we'll see another calculation. So that 1,022,600 will increase some amount as of, I believe it's around February 15th. Next slide, please. So the other provision of Prop 19 is the base year value transfer. This actually went into effect April 1st, 2021. You have to be 55 years and older or severely disabled or a victim of wildfire or natural disaster to qualify. The base year value to the replacement to any county in California before this provision, which was Prop 60, limited it to about 14 counties in the state that you could transfer the property to. Now you can take it anywhere in the state. The transfer or the new construction has to happen within 2 years to qualify, and you have to have filed that claim form within 3 years of that purchase or new construction of the property. So in some cases, people buy vacant land as a replacement property, and they want to move to that property. They have to have that house built within 2 years in order to take that exclusion with them. They have to transfer 100% of that original principal residence to the new property. And then the new feature in this law is you can do it up to 3 times now in your lifetime. Before it was a one-time deal. And most of it, again, was limited to the county you were in or 14 other counties that participated. This calculation is a little unique, so I wanted to kind of present this to you too, so you understand there is some times where there's an additional value that gets added. Next slide, please. So if the replacement property is purchased after you sell the original property, the basic formula is, say the property was valued at $300,000 currently, and the owner sells their original property for $700,000. And buys a replacement property to $740,000. If that replacement property was bought in year 1 after that, after the sale of the original property, there's a 5% inclusion to the sale of the original property that allows it to increase to $735,000. So you look at that $735,000 and match that up to what the new residence was. In this case, I use the example of $740,000, and that difference is what gets added to the original base year value or market value, or factored base year value or assessed value of the property. So in this case, you'd add $5,000 to the assessed value going forward. If the property was purchased in year 2, they actually allow for 10% to be added on to the sale of the original property. So in this example, that becomes $770,000. So there isn't really no excess value based on what the new replacement property is. So no additional assessment is made to the new replacement property. It's looked at as zero value, and it maintains $300,000 provision. So that's kind of unique and something to remember when somebody's looking for a replacement property. Next slide, please. There's a little different though if you purchase your replacement property before you sell the original property. The benefits of that 5 and 10% don't apply, and that In this example, though, if the replacement property's purchased for $730,000, and when you go ahead and sell your primary residence for $700,000, that difference, that $30,000, would be added onto the current base year value or assessed value of $300,000. Next slide, please. So concluding that on Prop 19, the other area that the assessor is required by law to look at values and maybe make adjustments to the assessments are Proposition 8. They passed a few years after Prop 13 was passed. And this would basically said to the assessor, if you find that the market value is now less than the assessed value, you have to, by law, reduce that value to the lower value. And this would be on lien date, which is January 1st every year. So under that, the assessor is required to assess the value at the lower of the two values, whether it's market or the base year value. And then we would notify the taxpayer with a value notice. Obviously, this occurred back in the Great Recession in the late 2000s. When property values really went down, the assessor readjusted values for thousands and thousands of properties in this county. Next slide, please. And this slide, I kind of wanted to demonstrate a little bit on how it worked. If you look at the blue line going through the middle, that's us looking at that original purchase price and the factoring of that maximum 2% for the year. So we always maintain that value in our database to look at the value. In this case, they bought it in year one for $800,000. Year two, the market value went up to $850,000. So there's no reassessment. The assessor would assess it at $816,000. That's the 2%. But in year three, the value went down below the factored base year value at $775. So that's less than the $832. The assessor would put $775 on that value. And the next year, it went down again. We would have to lower that value down to the $750 because it's all below that factored base year value. Then in year five, it goes up quite a bit, though. It goes up more than 2%, but it's still below that factored base year value. The assessor would put on the $825. Proposition 13 doesn't apply in this instance. It's the rule of Prop 8 that allows us to adjust it, the market value below the factored base year value higher than 2%. And as you see, year six, we're getting closer. In year seven now, market value came back and the property is worth $935,000. The assessor cannot put that value on the roll. They put the $883,100 by whatever the CPI is that year, which would be $900,700. And so that's a little bit how Prop 8 works. And so once a property goes on Prop 8, the assessor is required to look at that value annually. So when values go down, the assessor's workload actually increases because, as I mentioned before, we have thousands and thousands of properties that we have to review annually to see where they are adjusted to. With that, that's pretty much what triggers reassessment. We can go to the next slide. I just kind of wanted to make people aware a little bit because I'm usually called the tax assessor, but I really have nothing to do with the taxes. I have everything to do with the property values and discovering property and putting that value on the roll. The auditor actually applies those tax rates, makes any corrections, prorates the bills, and calculates the supplemental bills. And the treasurer tax collector sends off the tax bills and collects the taxes. So a lot of times people call us about numbers on their tax bill, and we are unfortunately unable to answer it because those aren't things we're adjusting for that tax bill. The one item in the tax bill you'll see that is the responsibility of the assessor is usually the first line that says ad valorem tax of 1%, which again is Proposition 13. So we do get a lot of calls, but I also want to say, you can put the next slide, please, that we are willing to take phone calls, your emails, check our website, come to our office and help you in any way possible to understand how your assessment is done, how the assessment was calculated, give you the information we use to be transparent on that value. And we pride ourselves on our public service and want to make that available to anybody that asks. And even if it's a question that maybe it pertains to the tax collector, we'll make sure we guide you in the right direction on where to get information for that. So please don't hesitate to contact the assessor's office whenever you have questions. And the last slide, please. I'm open for questions.
Thank you so much, Keith. Let me see. I think we have a few questions here. And Roxanne, if you could just unmute your
I just
microphone.
did.
Perfect, thank you.
Uh-huh.
All right, so first we have, does splitting a lot cause reassessment?
If it's a lot that has assessed value and you're just splitting it to make two lots, no, we just make a proration to both lots, what we think the value is on that. Usually if you split it right down the middle, it's probably gonna be a 50-50 split, but it depends on what's on the property if you split it. If you have a property you're splitting and a house that's on one property and it's vacant land on the other, obviously more value would go to the parcel, the lot that has the house on it. But if there's no reassessment, if it's already been assessed.
Okay, looks like there were some questions, but it looks like you answered them in the presentation. Last chance for any questions to pose in the Q&A. I'm sure if any come up, feel free to reach out to me or either to Roxanne or Keith. We'll be sharing the recording of this presentation with all the attendees as well as the slide decks from both of our presenters. Keith and Roxanne, thank you again so much for sharing your time and your expertise with us. We're just so grateful that you were available to do this for our members. And again, oh, another question just came up. Hold on. If the house changed to different user, does that affect tax?
If the house changes to a different use, it can affect the property value. If it's a house and turns into an Airbnb, it certainly does affect the value of the property. It becomes now an income producing property.
Okay, yeah, she's clarifying if the house becomes a church.
Yes, again, it's a change of use, but one thing with the church, you might be able to receive an exemption on it. And that's a separate form you can fill in our office and go through our exemption department to see if you qualify for that.
Fantastic. All right, well, that concludes our webinar, our tax assessment webinar. Thank you again, Roxanne and Keith, and hope everybody has a great day out there.
You're
Thank
very
you so
welcome.
much,
Thanks for
Laura.
having us.
Thank you. Yeah, I really appreciate it.
Bye.
Bye.